Capital Management Group, Wealth Management at Rehmann, Max Wallinger. Doug, Max, welcome to the show.
Good to see you, Bart. Good to be here.
Yeah, nice to see you back. I think it was like about a year ago that you were here, Max.
That's right.
Great to have you both here.
Actually, I think I was here in the summertime. We talked about our Make a Difference Day and helping with 4-H at the fair and our Rotary Rams.
That's right.
So,
did you buy a steer?
I did not. Don't have enough freezer space. That's a lot of beef.
It is. But you guys, as individuals and also as a firm, do a lot in the community. And I wanted to thank you for that and mention the various things you guys are involved in. And there's some coming up in the next month, and we'll chat about those in just a few moments.
Sure.
But wealth management, you're in business to help people hang on to their money and grow.
Right. So
let's talk about 2024 as we head into 2025. Max, how did 2024 shape up for investors? What were some of the key themes of the market?
Yeah, I mean, fortunately, it was a good year for the stock market, at least. It was actually the second year in a row in which we saw a 20% plus return for the S&P 500. So that's something that hasn't happened since the late 90s. Really coming into the year, there was a lot of concern around a potential recession, but that ultimately hasn't played out. In fact, economic growth was really pretty strong, and that meant corporate profits were strong. We also saw inflation across the globe start to come in, which has allowed central banks like the Fed to start to cut rates. So those two themes really helped drive stocks higher throughout a lot of the year. Then positive market response to the election as well, kind of cheering the prospect of lower corporate taxes and less regulation. So a good year for the S&P 500, up around 25%. But if you look outside of the S&P, a little bit more mixed. Smaller companies struggled a little bit. International was only up, around 6%, and that's really because there's been this concentration. A lot of that market performance has come from a lot of those large cap technology names that are tied to the AI theme.
So some areas were stronger than others.
Absolutely. So still a good year overall, but yeah, definitely some differences depending on where you're invested.
Another reason to have a diversification in your investments.
That's right. That's right.
So you mentioned the election, and Doug, with the new administration in office, just one weekend, right? Mm-hmm. What are some of the changes that you're helping your clients navigate?
Well, obviously, if you looked at the election, there was two contrasting styles, right? The former administration had significant discussions about potentially raising capital gains rates and changing the estate tax, and both could have had significant impacts. Probably the bigger part was the sunset of the Tax Cuts and Jobs Act that was passed in 2017 and will, without congressional action, expire this year. And what that would do is effectively create a situation where individual taxes go up. When they did the tax cuts, they did make lower corporate taxes permanent, but individual ones were not permanent. So if nothing is done by the end of 25, you're going to see individual tax rates go up. Currently, the estate tax is $13.99 million per person, or a couple could almost give $28 million without paying an estate tax. That would have cut back to about $7 million. So those things were areas we were looking at. One key point we're also watching on a go-forward basis as Congress negotiates and potentially does something to extend the Tax Cuts and Jobs Act is what is called SALT, which is known as state and local taxes. And sometimes people don't realize this, but when you pay taxes like your state income tax, your property taxes, etc., you get to deduct those state taxes on your federal return. The Tax Cuts and Jobs Act limited that deduction to $10,000, right? On a go-forward basis, some of the states, people in New York, California, some of the higher tax states are negotiating for a higher limit to that. We've seen numbers between 30, 40,000. It's obviously Congress, and they're going to negotiate this stuff. But that's another thing that could benefit some taxpayers as well with those changes to limits once they know what they're going to do.
So with these tax cuts expiring, it has nothing to do with the change in administration. This was a can that started getting kicked down the road 10 years ago, right?
Right. The only difference is it was less likely that the prior administration would have defended it. They were actually on kind of point of saying, hey, we want it to expire because it'll raise taxes. The current administration is going to be very proactive in extending it to try and keep taxes lower, which, to Max's point, then impacts corporate profitability, And of course, consumer spending, because the more money we have in our pocket, the more dollars we can spend.
All right, the economy. It's the economy, right? Max, you mentioned we've had, a resilient economy. We've had economic growth, but it still seems there's a lot of risks looming, and everyone's talking about the price of eggs. So what's your outlook for the economy and the potential risk for the R word, recession?
That's right.
Going forward?
I mean, that's the big question. It's hard to predict. I mean, I'll say recessions are a normal part of an economic cycle, but they're very hard to predict when they're going to occur. So it's hard to answer that question with a ton of certainty. But what I can say is we know that economic expansions don't just die of old age. And by that, I mean, there has to be some sort of catalyst. And right now, we're not seeing a lot of obvious catalysts or imbalances in the economy. Overall, economic activity has been really pretty encouraging when you look at the data. You've got a very strong job market. Businesses are hiring. Unemployment's low. Wage growth is up. Inflation's coming down. Consumers continue to spend at a healthy clip. So overall, we think there's a lot to be to celebrate there. Yes, growth is slowing a little bit, but a lot of that sort of a normalization from that kind of post-pandemic recovery that we saw.
And a certain amount of inflation is a byproduct of economic growth.
Absolutely. I mean, initially we saw a big spike in 2022, which was in large part from kind of a big surge in demand when supply chains were all screwed up. Then you had stimulus on top, and the next thing you know, you get a bout of inflation. But now a lot of that stuff has worked its way through the system. But you're still seeing elevated prices, absolutely. But it has, it's moderated. I think the worst is behind us on the inflation front.
Yeah, and I think that's very telling when you see that graph, and you do see the peak, and the peak is behind us. What about Social Security? Everyone's concerned about all the, I think, question marks that are hanging over Social Security, Doug. Are there any important changes that folks in retirement or nearing retirement age should be aware of?
Absolutely. I mean, there's always this argument that Social Security, if you read the trustees report, that it'll be insolvent in 2036. The challenge is that at cash flow basis, it would pay for 77 cents on the dollar, and Congress is likely to make adjustments somewhere before there. So we still feel Social Security, while there's uncertainty, is still going to be there for the long term. What changes are going to be somewhat dependent on Congress. But they did pass a law, and it was a major change to Congress, from Congress on the Social Security Act back right at the end of the year before Christmas. It's called the Social Security Fairness Act. And a little history on this, 1983 was the last time Social Security was in major trouble. When Reagan was president, they convened a commission that did some significant changes to it. And one of the things they did was they changed the calculation for anybody that worked in a governmental entity that had a pension that opted out of Social Security. And I think a lot of people don't realize you can opt out of Social Security. Here in Jackson, there's a lot of government employers that have. And what happens is somebody that had worked for that employer got paid less. They got their Social Security cut because they appeared as a long-term low-income worker. So for example, I worked 35 years, 10 at an employer that had Social Security, 25 in an employer that didn't. By its very nature, that meant that they looked like a low-wage earner, so they got more money. The government tried to change it. Well, this Fairness Act eliminated two parts: the windfall elimination provision, which impacted an employee in that situation, and the government pension offset, which impacted the employee's spouse. Those two are now gone as of January 1st, 2025. They're actually, anybody that was impacted, they're going to back pay them to the end of 24. And on a go-forward basis, those people are going to see their Social Security increase. Interesting concept. There's some argument that it'll add to the deficit, but it's, again, the argument was it's fair. That's why they call it the Social Security Fairness Act. So anybody, locally that worked for an employer that opted out is probably going to see a bit of a raise in their Social Security.
And government employees.
Government employees, the common rule, most people know it. I mean, because again, it's FICA. You're not withholding FICA out of your paycheck in order to do this. So ultimately, they're going to get more in their Social Security payment because the government did away with those two provisions, the WEP and the government pension offset.
All right, let's talk about some of the other things that you're discussing with your clients throughout the year. And we've got a couple of charts and graphs we've got to take a look at. And is this related to diversification?
Absolutely, yeah. I think one of the big themes we're talking with clients about is just the importance of rebalancing portfolios, and by that I mean kind of taking those parts of your portfolio that have done well and potentially trimming them to add to the areas of the market that have lagged. And that's an important strategy for managing risk, but also being kind of disciplined in buying low and selling high. So when for example, those large cap stocks that I've talked about have done really well in the last few years, but now valuations have gotten higher. There could be more limited upside from here. So we're talking with clients about maybe taking some profits, redeploying those into parts of the market that might have more upside. Similarly, portfolios are often now underweight to bonds because they've lagged, but because of higher interest rates, the outlook for bonds has really gotten a lot better. You're getting yields that are higher than we've seen for much of the last decade, so that means more income, better return, and you're getting some really nice diversification benefits there. They should hold up well if we see a recession. So those would be some big themes that we're talking with clients about here.
The Fed decided this week to not cut anything off the interest rate. Is that concerning?
No, I mean, it's really a function of the fact that there's been some slowing progress on the inflation front, and the economy's been really healthy. So they don't feel like they're in a big rush to stimulate things now that seemingly we're in a pretty healthy place. So, markets don't necessarily love that, but it's kind of a hold, a wait and see approach, and not necessarily something to be worried about.
Other than Social Security, other retirement products that you're keeping your eye on for 2025?
Sure. One of the biggest things is the Secure Act. Congress passed two of them. The original Secure Act, one in 2019, and then they passed an update to that in 2022. Some significant changes have come through. Now, contribution limits for 401ks have been indexed for inflation for years. This year, somebody that is, if you're like me and you're fortunate enough, your kids are out of college and you're really trying to pack it away, the limit is actually for somebody under 50, 100% will pay up to $23,500. Somebody over 50, you can get an extra $7,500. So a 50 plus can put away $31,000 if their budget allows it. But the interesting part to the Secure Act, which kicked out this year, is they put a provision in. It says anybody that is 60, 61, 62, or 63 actually gets a higher contribution limit. So anybody in those age groups can do an additional $11,250 this year instead of $7,500. That is brand new. There's been a host of other changes. Our employers at Rehmann that we work with, anybody that opens a new 401k this year, if you start a plan as an employer, they have to be auto enrollment plans, meaning everybody automatically gets enrolled, as opposed to do you want to? So that's been a major change. And there's some other things coming down the pike that we're looking at next year. We're starting to plan for it now, but next year, part of this provision was anybody, which this is going to be management oriented, anybody that makes over $145,000 in a company, if they do, and they are doing that catch up, if they're over 50, that can no longer be pre-tax. It has to be Roth. So we're starting to plan ahead for that as well. And again, it's considered a revenue raiser. Somebody that makes a little more, they don't get the full pre-tax deduction anymore. You can do the 23.5, but not the rest of it.
All right, well, obviously a lot of reasons to have a professional assist you with all of these changes and questions. And I would say, you mentioned age, it's when you hit 60 there, and it's very specific when you do what you do from age, 59 going forward.
Right.
So these folks are ready to help, and you can contact them. They've got offices right here in Jackson and all over Michigan. Mentioned your community involvement. You've got a sponsorship coming up. I think the next one is silver sponsorship of the Black Excellence Awards.
Yeah, I believe that's February 7th, coming up soon. So yeah, Raymond's proud to be a sponsor in the awards, and we've got a table, and we think it's a great event. So can't wait to do that. And we sponsor a lot of events in the community because again, we're good partners, and we want to be good partners of our community.
Yeah, you were at Art Beer and Wine, a lot of things last year. Next, after the Black Excellence Award, is your presenting sponsor of the State of the Community, where Mike Overton and Jonathan Green are going to tell us where things stand locally.
Right, absolutely. Dave Page Jr., our managing principal, will be the main person and doing the introductions of everybody and a little keynote. So yeah, we're looking forward to that as well. Good to see what's going on around town.
Well, thanks for all you guys do, and thanks for being on our show today.
Our pleasure.
Thank you for having us.
Guest number 2 and 3 of our 25th year of the show.
Wow. Nice to see that kind of longevity, Bart.
Thanks, Doug. Doug Barber and Max Wallinger from Rehmann Wealth Management.